Accounting cycle. Accounting cycle refers to the process which starts with recording of opening entries in the journal and ends with the preparation of financial statements. The following steps are included in the accounting cycle. Number 1, start with business transaction. This is the first step. Whenever a business does something financial, it creates a transaction. For example, cash sales, purchase of furniture, payment of salary, rent received. Every transaction has to be recorded in computerized ERP software. Number 2, journalizing. In this step, the transaction is first recorded in the journal. The journal records date, accounts affected, debit amount, credit amount, short explanation. This is called the Book of Original Entry. For example, if cash sales are made, then cash account increases, sales account increases. So the entry is written in the journal. Number 3, posting to ledger. After journal entry, the information is transferred to the ledger. The ledger has separate accounts like cash account, sales account, rent account, salary account. Each transaction is posted to the correct account. Why this step is important? It helps us to see the total balance of each account. Number 4, preparing trial balance. After all journal entries are posted to the ledger, a trial balance is prepared. A trial balance is a list of all ledger account balances. The purpose of trial balance is to check whether total debits equal total credits and find errors in recording or posting. Why this step is important? If debit and credit totals do not match, there may be a mistake. And here is a Number 5, adjusting entries. At the end of the accounting period, some items need correction or update. These are called adjusting entries. For examples, outstanding expenses, prepaid expenses, accrued income, depreciation, income received in advance. Why this needed? To show the true financial position of the business. Number 6, adjusted trial balance. After adjusting entries are made, a new trial balance is prepared. This is called the adjusted trial balance. Purpose of this adjusted trial balance is to confirm that debits still equal credits after adjustments, to prepare financial statements correctly. Number 7, financial statements. Now the business prepares its final reports. That is, main financial statements. It includes income statement, shows profit and loss. Balance sheet, shows assets and liabilities. Cash flow statement, shows cash inflow and outflow. Why these statements are important? These statements tell us how much profit the business made, what it owns, what it owes, how much cash it has. Number 8, closing entries. Temporary accounts are closed at the end of the accounting period. Temporary accounts include revenue accounts, expense accounts, dividend account. These accounts are transferred to the capital or retained earnings account. Purpose: reset temporary accounts for the next accounting period. Fresh start for the next accounting cycle. Number 9. Post-closing trial balance. After closing entries, another trial balance is prepared. This is called the post-closing trial balance. It includes only real accounts, permanent accounts. Purpose: check that the accounts are balanced after closing. It's ensure the books are ready for the next period. Number 10. Start next accounting cycle. The cycle does not end permanently. After one period is completed, the same process starts again for the next period. That is why it is called accounting cycle. Thank you for watching, guys. If you found this video helpful, hit that like button and leave your valuable advice below. And please subscribe to our YouTube channel so you never miss an update, and share it with your friends.